Today, the RBA predicts house price falls. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Well, the RBA released their twice-yearly Financial Stability Review, the FSR, today. And they say that global financial systems have continued to function well over the past 6 months, with further waves of COVID-19 having limited impacts on financial institutions and markets. A new source of uncertainty, though, they say, has been Russia's invasion of Ukraine, which has accentuated some existing risks in the global financial system and created others. Commodity prices have increased sharply, and there has been an increase in market volatility, which has resulted in some market participants facing liquidity shortfalls. However, they say, most international banks have only minor links to the Russian and Ukrainian financial systems, and so direct losses from those exposures do not pose a significant risk to these institutions or the global financial system. Nevertheless, the large falls in Russian asset values have meant losses for some investors, with some essentially writing off the value of their Russian investments. For example, one of the UK oil companies has written off £5 billion thanks to their Russian investments. Since late 2021, long-term interest rates have increased significantly following higher than expected inflation in many countries. Expectations of future increases in policy interest rates have also been brought forward. As a result, the prices of some financial assets have declined, although there have been no widespread falls in residential or commercial property prices. I'd say yet. With inflation higher and more persistent than forecast, there's a risk that short and long-term interest rates could increase by more than financial markets currently expect. And it's possible that the current disruptions to supply chains persist, prolonging the period of higher inflation and contributing to a shift up in inflation expectations. If so, policy interest rates in major economies might need to move higher than the currently expected peaks, which are relatively low relative to the peaks in interest rates over recent decades. In Australia, they say the financial system has remained highly resilient and supportive of the economic recovery. The banks remain very well capitalised, have high holdings of liquid assets, and have ready access to wholesale funding. Loan arrears rates are low and have declined a little recently, and businesses and household balance sheets are in generally good shape, with many households having built up substantial buffers on their mortgages. Even so, housing credit growth has for some time exceeded growth in incomes, with the ratio of housing credit to income edging up from an already high level. So they called out some key risks to the financial systems. The first one was that highly indebted borrowers could struggle with rising interest rates and expenses. They said in many countries, debt-to-income ratios are at high levels in the household and business sector. Higher interest rates will increase borrowers' debt payments, while high inflation will reduce the funds households and some businesses have available to make those payments, particularly if incomes stagnate. Loan performance could then deteriorate significantly. The risks of high indebtedness have been highlighted by the significant worsening in the financial health of property developers in China, where efforts to reduce leverage risk a disorderly unwinding. A rise in global interest rates could trigger sharp capital outflows in emerging market economies, particularly those with weaker economic fundamentals and significant foreign currency debt. The high level of household debt relative to income in Australia has increased the sensitivity of households and their spending to high interest rates and a rise in living expenses. While banks have generally maintained strong lending standards, a large share of new housing loans have been written with high debt-to-income ratios. With interest rates still at historically low levels, it's important that lending standards are maintained and that borrowers are prepared for an increase in interest rates. The second risk they see is that many asset prices remain high, but could fall with increases in interest rates or risk aversion. Globally, asset prices generally remain high, and there is ongoing risk that a disruptive adjustment will occur. This could be triggered by larger than expected increases in interest rates, an increase in risk aversion due to global developments, dislocation in financial markets, or weak income growth. Where assets are highly leveraged, in particular residential and commercial property, large price falls could lead to significant losses for financial institutions, disrupting the functioning of financial systems. And the third risk they call out are cyber attacks continue to pose risks to financial systems and institutions, cyber attacks have become more frequent and more sophisticated in recent years, and it is highly probable that at some point in time, the defences of a significant financial institution will be breached. This would not only create problems for the institution concerned, but it could also undermine confidence in the broader financial system. It therefore remains critical, they say, that financial institutions and infrastructure have high resilience with the ability to quickly recover from a significant attack. So now let me look in more detail at the household sector, because the Reserve Bank is warning of serious risks for those who are heavily indebted with limited savings buffers. And while painting a general upbeat picture of the resilience of the Australian households as interest rates rise, it's this sector that we should focus in on. The banks reported that on the whole, they say, Australian borrowers are in a much better position to deal with rising interest rates than they were before the pandemic. Most indebted households have benefited from strong growth in housing prices over the past year, and coupled with high mortgage repayments in excess of scheduled requirements, the vast majority have accumulated substantial additional equity in their homes, the report noted. The RBA estimated that only 5% of loans now have an outstanding loan-to-value ratio greater than 75%, compared to almost a quarter at the beginning of 2020. This means that for 95% of borrowers, it would take more than a 25% drop in home prices to send them into negative equity, the dangerous position where the borrower owes more to the bank than their home is worth. The share of loans in negative equity is also estimated to be exceptionally low at less than 0.25%, down from 2.25% in January 2020, the review added. The improvement in both these metrics have been mainly driven by the exceptionally strong surge in housing values during the pandemic, with property prices surging by almost a quarter over the past year in the steepest growth since the late 1980s. But the RBA also warned that much of that gain is likely to be unwound over the next couple of years as interest rates rise. Estimates using a model of the housing market that takes into account historical relationships between interest rates and both demand and supply factors suggest that a 200 basis point increase in interest rates from current levels could lower real housing prices by around 15% over a 2-year period, the FSR noted. Now pause there, because in an earlier model, the Peter Tulip model, there was a much stronger relationship between movements in interest rates and house price moves, and they suggested then in that other modelling that a 1% rise could translate to a 30% movement in prices over 3 years. So I wonder which model's right. So this is what the RBA said in an earlier report. Remember that they're talking about falling interest rates, but of course the reverse is also true. It's a bit opaque, but it is interesting to try and get a handle on what they're saying. At a user cost of 6%, we estimate that a sustained percentage point drop in interest rates would, in the long run, boost housing prices by 17%, holding rents and other components of the user cost equal. This semi-elasticity, the proportionate increase in housing prices for a given percentage point increase in interest rates, is larger than the time series estimates of other analysts, perhaps because they control for many other variables affected by interest rates like share prices and income, so only capture part of the effective interest rates. But the estimate from the RBA was similar to other analysis estimating 20% for Sydney house prices using disaggregated census data, and another analyst who came up with an estimated range of 19 to 33% for the United States in a calibrated model. A user cost or rental yield of 6% is the approximate average used by those studies. User cost models imply that the semi-elasticity increases as the user cost declines. Effects on prices become extremely large as the denominator approaches zero. And here's the killer, they wrote, with a current user cost of 3.5%, which is of course well below that observed in the studies, a percentage point drop in the expected real mortgage rate would boost housing prices by 28% in the long run. Just think about that again. A 1% drop would actually lift house prices by 28% in the long run. But of course the reverse is also true. A 1% rise would translate to a 28% drop in housing prices. So the question I want to ask the RBA is why in their new model have they now calibrated it back to 15% over 2 years on 2%, compared with 1% and 30%. We should be told, I think. I think somebody's getting cold feet on all of this modelling, because I think that the 28% is probably a more accurate measure of what's likely to happen. There is no doubt in my mind that there's a very strong correlation with the interest rates and with house prices. Why have house prices gone so high over the last couple of years in so many countries? Simple. Interest rates were cut to the floor. And as you reverse that, it is highly likely that home prices are going to get devalued, and get devalued actually quite quickly. So I suspect the RBA is understating the true impact of prices. But we'll see. And so we need to consider whether borrowers are indeed prepared for higher repayments as record low mortgage rates disappear. An analysis by the Reserve Bank revealed that most borrowers should be able to cope with those relatively higher repayments, and relatively comfortably, if interest rates were to rise by 2 percentage points, which is around the middle of current economic forecasts. The RBA's analysts found 40% of borrowers are already making average monthly repayments that would cover the increase in minimum repayments. Another 20% would see their payments rise no more than 20% from what they're currently paying. However, 1 in 5 borrowers would see their minimum repayments increase by 40% or more. Those borrowers also tend to have lower accumulated savings and loan repayment buffers than the average mortgage customer. While the average borrower has a buffer around 45 months at current interest rates, the median or typical borrower is at 21 months ahead, up from 10 months at the start of the pandemic. But of the quarter of borrowers whose repayments would rise by 30% or more, only half have accumulated excess payment buffers equivalent to at least a year's worth of their current repayments. So the households facing the biggest increase in repayments, dominated by more recent home buyers, also on average have the smallest financial buffers saved up to cope with those higher repayments. With 2 percentage points of rate increases, the proportion of borrowers facing a debt servicing ratio greater than 30% would double from around 10% to just under 20%. Now, this 30% level is quite important because it is considered by some to be a level of repayment that puts borrowers in a high risk of mortgage stress. Although, of course, I define mortgage stress differently in terms of cash flow, and that cash flow measure does come in rather differently to the typical standard one that's being used here. And today, in my modelling, more households are in difficulty already. The Reserve Bank also warned of the potential risk of a double whammy for households facing higher interest rates if wages growth did not pick up to match. If rising inflation was to erode real household incomes, some borrowers may have to draw down their accumulated excess payment buffers much more quickly and or cut back on other spending, it noted. That led the Reserve Bank to conclude that medium-term systemic risks remain elevated. It's important that lending standards do not slip and that borrowing and lending decisions are resilient to higher interest rates and the potential for falls in housing prices and or real incomes, it cautioned. And then it went on to look at high debt-to-income loans, because there have been concerns raised about an increase in high debt-to-income lending over the past year, where borrowers are taking out debts more than 6 times their annual household incomes. Such loans make up nearly a quarter of all mortgages issued in the last 3 months of last year. The RBA noted that around 60% of the increase in high DTI lending has been for loans with ratios between 6 and 7, although that means about 40% of the increase in those higher risk loans have been for loans where households are borrowing more than 7 times their annual income. And in New South Wales, particularly around Sydney, it's quite often 8, 9 and 10 times. Aside from the risk of borrowers being unable to keep up their loan repayments and defaulting, the Reserve Bank is conscious that heavily indebted households might make the economy more sensitive to interest rate rises than in the past. High DTI loans can also increase macroeconomic risks, as these borrowers are more likely to need to reduce their consumption when faced with a cash flow shock, the report noted. However, the bank did add that many of the households with high debts relative to incomes, especially investors, also had significant savings and wealth. Liaison with banks indicate that some high DTI loans are originated with relatively large offset account balances, the FSR noted, and it also observed that only 1.5% of loans issued in 21 December's quarter had both a loan-to-value ratio of 90% and a DTI above 6, but added that those borrowers are estimated to be 4 times more likely to report mortgage stress. Nonetheless, banking regulator APRA has recently completed consultation with lenders on its plans to require them operationally ready to implement limits on high DTI, high LVR investor, or interest-only lending, or a combination of any of those two. And that will give the regulator the ability to quickly restrict that type of lending if it feels that they are becoming too prevalent and creating risks for the broader financial system. And while the focus of the FSR is on the stability of the financial system and therefore focuses heavily on mortgages and other borrowers, the RBA also noted that there are currently far more renters vulnerable to financial stress than people with home loans. 15% of renters were vulnerable to financial stress, defined as less than a month of disposable income in easily available savings and spending more than 30% of disposable income on rent. And it warned that this could be a financial risk if it meant more vacant properties and rental arrears or falling rents for landlords. Now, I must tell you that I think the RBA continues to look at the economy through very rose-tinted spectacles. There are a few reasons why they're doing this. Firstly, a lot of the analysis is based on 3-year-old data from the Hilda survey rather than more recent data. That's a problem. The other point I want to make is that other modelling, as I mentioned earlier, has a higher movement in prices with interest rates. And so if interest rates do go up 2%, then the chances are that home prices could fall a lot further than 15%. But the third point is that by not looking at household finances holistically, as I do, they're missing the big picture here, which is that not only are mortgage rates rising and therefore payments for mortgages and rents are rising, but also there are higher costs of living, higher costs of fuel, as well as childcare and other costs. And it's only when you put all of this together and understand the total status of household cash flows, rather than their balance sheets, that you get a real feel of what is going to happen. And I want to remind you that my modelling shows that if interest rates did rise by, let's say, another 2%, then that would put another 350 to 500,000 households in mortgage stress based on my definition, which is a cash flow definition, and that would move them from 1.5 million closer to 2 million households. That is a big economic shock and would have a very significant impact on the broader economy, let alone on individual households. So my own view is the Reserve Bank needs to take off their rose-tinted spectacles and look at things in a bit more detail and specifically stop averaging everything, because within the average you miss the divergence that there is. There are some households doing very well. There are also quite a large number of households already in difficulty, and that difficulty is likely to get worse in coming weeks and months. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.